Today, we're ranking the most popular mutual life insurance companies. Rod, I'm excited about this.
Oh man, I am too.
Hey, we have to talk about the criteria, Rod. So there's got to be more to it, but that's what we're going to do. We're going to rank the most popular. We're going to start from the very worst companies to the very best company. But what is the criteria?
What we're going to do is we're going to do it based on their ability to create cash value for you. Because if you're getting into a whole life policy with a mutual life insurance company, you're doing it because you want to build cash value. So why would you settle for a whole life policy that doesn't build you cash value if you can go get one that does?
So one of the unique things about mutual life insurance companies is that they pay a dividend. They have whole life insurance policies and they pay a dividend. So we're ranking them and we have 4 tiers. We're going to start with the worst. And I have bad news because there's a lot of companies in the worst tier. Rod, name us some of the all of the companies in tier 4, but maybe before we do it, tell us why they fit into this tier 4.
Yeah, well, tier 4 is for those companies that really don't do a good job of building cash value at all. So in other words, can you imagine this, you put money into the policy, let's say you put in 100 grand into your policy year 1 and you have 0 cash value. You put another 100 grand in year 2, you still have 0 cash value. So it's not until like year 3 in most of these examples before you start to see any value in your policy. So you're paying for a really expensive life insurance policy because you get the life insurance, but you're just not really getting any living benefits, any cash value in it at all for a few years. And long term, you're going to end up with like maybe a 1.5 to 2% IRR on the dollars you put in.
Okay, Rod, those are pretty damning words. That's all I have to say. So who fits into this criteria based on your experience?
Yeah, unfortunately, there are a bunch of these mutual companies that do it. So we're going to start with Minnesota Life as like the absolute worst because they just don't even really offer a whole life policy or participate in a whole life policy at all. Okay.
So they're like giving you a fake out. It's a mutual company. They they look like one, but they don't really act like one.
They don't. Yep, they don't.
That was my experience. I've worked with them over the years. You can get really cheap term insurance with Minnesota Life.
Yeah,
so they have their value in other ways.
Yeah. Yep, exactly. And some of these others would fit the similar things. So Pacific Life fits in the category. Principal, State Farm, Navy Mutual, Mutual of Omaha, Security Mutual. Yes, I just named a bunch of companies. And they all fit in this 4th tier.
Okay, be honest though, Rod. Are some of these ones worse or better than others in the same tier? Because it seems like when I look at my experience, I gotta think Mutual of Omaha is still a decent whole life policy. Like, relatively decent.
Okay, long term, like I say, long term, you still end up with cash value. You still end up with a positive IRR on the dollars you put in. In other words, you're paying it pays for the insurance, and long term you end up with more in the cash value than what you've put in. It just takes a long time with these companies.
So the bottom line though is if you're looking for a whole life policy that builds cash value, don't go into the tier 4 companies. Okay, great. Let's move into tier 3 where these companies are at least players in the high cash value life insurance space.
Yeah.
So that would be my thought on them. And yet they're like we say, they're tier 3, so they're not the best of the best, but they're at least better. And Rod, I would say this: a lot of these companies are companies that many of you will know, and a lot of people might have life insurance with these companies. Okay,
very likely.
Rod, take us through those.
Yeah, so the 3 we have on the tier 3 level are New York Life, American United Life, and Northwestern Mutual.
Okay, so 2 of those companies are in the top like 3 or 4 biggest companies that exist. Why do you think that is?
I think, well, we'll take Northwestern Mutual especially because they're the biggest, right? Clearly, they're way larger than even number 2, right? New York Life would be number 2. If you talk to them or anybody who's affiliated with them, they will pretend like nothing else even exists. Because why would you care about anyone else if you can't just get the biggest?
Right. So their message is, hey, we pay out by far and away the biggest dividend, but it's not on a per policy basis is just the biggest dividend. So like, yes, you're the biggest company and yes, you pay out a massive dividend, but how does that impact me as an individual policyholder? That's really what you have to be asking yourself. And I think what's happening here is I think these companies think they're so big and so popular, and maybe they are, that they don't really have to be the best at that, right?
Yeah, it's like
they have the market share already.
Yeah, it's like the Cadillac of these, and so they don't have to make the best car because people buy it. They're buying it for the name or the reputation, the size.
Do people buy Cadillacs for that reason, Rod?
Well, they used to. It's probably an outdated reference because that's not. But that's where that saying comes from.
Most people won't even know who American United Life is, but they in the past were bigger players in this space. But after some of the last low interest rate time frame of the last 10 years, they kind of fell out of favor and have been less of a player, at least less of a strong player in the high cash value life insurance space.
If you were to have a properly designed, highly overfunded life insurance policy with any of these three companies, your long-term IRR you could expect to be maybe in the 3.5, 3.8 range.
All of these interest rates that Rod's giving are based on the last 10, 15 years of interest rates. I have to just state this because whole life insurance interest rates are without a question going to be going up. What I mean is their dividend is going to move up as interest rates continue to rise or stay higher. Okay, that said, now we need to move into number 2, tier 2. So if you're in tier 2 and you've got a life insurance policy focused on building cash value, you can feel pretty good if you're in this space, especially right now. Okay,
again, assuming it was properly designed to be
that is an important caveat. Maybe you should, before you get into the tier 2 companies, hit on what that means when you say properly designed for the purpose of building high cash value.
Yes, and this is a critical point because any individual policy written could fall into tier 4 if it wasn't properly designed. In other words, if you have a policy that is just base premium, that's all you're putting in, you don't have the ability to overfund it, and they didn't include like a term rider or something that helps you optimize, basically reduce costs so that the cash value grows better. If your agent didn't build it that way, then your policy unfortunately falls in tier 4, even though the company itself could have done better for you. So we are assuming that it was optimally built towards the
building
cash. Yes.
Which again means minimum cost, maximum cash. Simple as that.
Yep.
And unfortunately, most agents don't write policies like that because they're not incentivized to do so. But that's for another conversation.
Yeah. So tier 2 is Lafayette Life, Guardian, and Mass Mutual.
Okay. Those are companies that most people, some people know, right? And they're competitive in cash value.
So in this range, you're getting between like a 3.8 to 4.1-ish IRR is the kind of what you can expect.
What you have expected, Rod, I just can't say this enough. What you can expect, interest rates are higher. People are getting 5% in CDs. So if my whole life policy is giving me 3.8 and I could get a CD of 5, I'm going that way. Well, maybe not. There's a lot of other benefits, tax benefits and stuff like that. But anyway, I just want to emphasize that that's where it's been. I do believe, without any question in my mind, that it will be going higher moving forward. Okay, let's get into tier 1, Rod, and this is where we write the majority of our business. So I was going to say we're partial to it, but we're only partial to it for one reason. We're partial to this singular company, which stands in tier 1 by itself, because for the last, 15 years, it has been, without any question, the best company for building cash value in your whole life policy. Who do we have in tier number 1, Rod?
Tier 1 stands alone. It's Penn Mutual. So we only have one company here. And the biggest reason is because there's a big difference between number 1 and then when you fall down to that tier 2, those 3 companies we mentioned there. And like I said, where we have been 3.8 to 4.1 for the IRR, with Penn Mutual, it's consistently been above 4.5 closer to 5%, especially for younger people.
Okay, so tier 1 all by itself, Penn Mutual. Tell us what you think in the comments below.
Join us for the Invest with Benefits Virtual Summit, an all-day event on September 12th starting at 10 a.m. Eastern Time, 7 o'clock Pacific. We're going to have top leaders in the financial industry, hard-hitting education, motivation, and how-to advice. For those who already are or want to get into investing in the alternative space, we're going to talk about investing in various forms of real estate, precious metals, other types of alternative assets, tax strategies, asset protection, and much more. Click here to get registered.